Hi, everybody, and welcome back. Man, we're due for a breakout year. I mean, we've been chomping at the bit for our market to finally break out. It's been nearly 3 years, and we're getting there. A little. Actually, a little more than a little. Piano piano, as they say in Italian. We've had below than average deal volume ever since interest rates decoupled from the fantasy decade of the ridiculously low and really out of the ordinary low rates, which was really between 2012 and 2022. Ever since then, when rates started to spike, deal volume contracted. But this never meant and doesn't mean that demand is low. No. You know, life's a funny thing. It happens and people need to move. It's a constant force that doesn't ebb. And this force has had nowhere to release itself for years. So demand is pent up. And demand in Manhattan is always strong. It's about prices. When things are priced right, they sell. You know, I've said in the past that deal volume is acutely sensitive to mortgage rates. When we see even a fractional downward move in rates, we see deal volume spike. And since September, we've also seen a distinct shift in buyer sentiment. It's accelerating. The serious buyers have already accepted the new normal of real mortgage rates, which are 7-ish, not 3. Open house traffic is up. Mortgage brokers are experiencing increased requests for buyers to get pre-approved. And there's growing numbers of offers being made. So the marketplace is busy. And it should continue to get busier as we get deeper into the selling season, but not busy like we saw in the mid-2010s, which was more frenzied. But the market is awakening. And part of that has actually been that we've seen realistic price adjustments from sellers. And all of this shows is that buyers, serious buyers, have acclimated to mortgage rates. They've accepted it. And they know that the 3% rates, they're a thing of the past. You know, a dynamic of Manhattan is that it's heavily weighted towards users, not investors. And that's a longer term play. Those who are active in the marketplace right now understand that. And they recognize that we're likely at the beginnings of a multi-year run of escalating prices. We have tight inventory, a growing acceptance of current market dynamics, and an eventual easing of rates, all of which create intense competition and therefore rising rates. So buying now will be far more affordable than buying 1, 3, 5 years from now. The bigger issue now, more so than mortgage rates, is supply. Although we're starting to see an increase in inventory, primarily due to the seasonality and the coming selling season, we're still below past year's levels, particularly since the spike in rates, which began 3 years ago. This is the real reason for muted deal volume. Low supply, not demand. And a lot of sellers are still on the sidelines. Now, for sellers who are actively listed, if you misprice, you will be penalized. Look at this chart from Urban Digs. If you're listed for more than 120 days, the average discount is 9%. When you miss your mark, you're penalized. Conversely, if you sold in less than 60 days, your discount is only 1%. When you price right, you sell efficiently, faster, and at a higher price. Look, if you're getting showings, but no second showings or offers, then your price is too high. If you're not getting showings or even inquiries, then you are grossly overpriced. Orchestrating a successful sale experience requires thoughtful preparation and timing. You want to price sharply to value, generating multiple interests and possibly even generating a bidding situation, which is ideal. So that's where we are now. We'll see where we go, but it'll likely be busy. And in the meantime, have a great February.